Oh, we just went live. Okay. All good. All right. I got some announcements for you guys for 2025. Cool updates, tips for 2025. Basically, how to carry over, like how to not waste all the progress you've made by not locking in the lessons. So I think doing a review at the end of the year, crucial, if not like like absolutely mandatory. And it'll just help you. And this is why I want to show you guys the FX replay, the simulator, because this is so much fun, but it also helps you track a lot of your decision making on the charts. And so you'll basically just like you have to trade this the same exact way you would trade your live account. And I think that if you can turn your lessons into rules that you can take with you into 2025, I think that's how you can measure your progress. So a lesson may be, let's say, like making money and then giving it back. And so one of the rules will be, after two winning trades, walk away. That's something you've seen in your data. You have to turn the lessons into a rule, take those to 2025, then you become a better trader, and you can start the next part of your journey. All right. So I'm not going to be taking this trade, just as a heads up to everybody. I'm going to be watching this through, but I'm going to go grab a drink real quick while this rejects. If you guys have any questions, any pairs you'd like me to cover, or you want to send your charts in the chat for me to review, send those in. Be back in 2 seconds. All right, locked and loaded. I had to get some green tea and a Zen pack in. Now I'm ready to go. Welcome back, people. I know it's been a long time since we've done a stream. Obviously, very busy planning for Latin America, but Chart Addicts got a lot of things kicking off for 2025. A lot of new faces going to be joining the squad. Mostly, they're going to be well, not mostly. All are going to be former students or existing students. They're going to be stepping up. They've shown a lot of success, a lot of leadership, and hopefully they'll be able to pass on a lot of what they've learned over to you guys. So pretty exciting stuff going into 2025. Some tips and reminders. So this is a practice I've been doing since I started trading. Obviously not the first 2 years, or maybe not the first year, because I was very stubborn. I tried to do like a very superficial version of this, but it's the annual review. So some people get too lost in reviewing, always looking at their data. Some people don't look at their data enough and they're constantly falling into the same traps. The perfect middle ground is to prepare so much that you know what you're doing, you know the outcomes you can expect, and then every once in a while or on a, predetermined basis, let's say weekly, quarterly, annual, you go and review. That way you can course correct. Okay? If you're watching the analytics too much, if you're looking at your data and overthinking it, overanalyzing it, you'll probably be drawing conclusions that aren't even there. And so what you need to do is focus on getting better at the act of trading, the act of managing a trade, the act of executing without hesitation, predetermining your exits, where are you going to get out, holding and having the patience and the persistence and the confidence to hold, right? So now going into the end of the year, very important to do the annual review, which is to look back at, you're going to have a lot of different phases of your trading. I know it might seem difficult, but try to put together a list of all the accounts you've opened, whether it's prop firms or live accounts. And if some of you guys are saying, well, I've opened a lot of accounts this year, that's going to be a lot of work. Good. It's just like it's just like backtesting or journaling your trades. If you're taking too many trades to journal and it's just too much work for you to even keep track, chances are there's probably some errors happening in there that you can adjust. And so if you find yourself at the annual review, you have a lot of accounts in a lot of different places and you got to put it all together, that exercise will help you get clarity about what you've been doing, how you've been spending your time, and how productive it's been. Now, for some people, this is very uncomfortable, but it shouldn't be. What's uncomfortable is ignoring the stuff and remaining a loser. That should be uncomfortable. Figuring out how to get better and getting better kind of sounds like a win. Maybe it's just me. Okay. So the annual review is at Chart Addicts. We do this in two parts. You guys can obviously, I might include the link to the annual review guide somewhere in the description, but the way that we do it is focusing on quantitative and qualitative. So quantitative means things you can measure. So you're going to be looking at your win rate, your overall risk and reward, obviously your total profitability, your bottom line, your P&L. You'll be looking at even more maybe specific metrics that apply to you. The duration that you're in these winning trades and the duration you're in these losing trades. For example, for me, if I'm in a trade longer than 4 hours, it's probably going to be either break even or a loser. If I'm in a trade for less than 15 minutes, it might be a winner, but it's going to be a small winner because the losses I have in that 15-minute, like if I'm trading, if I'm holding a trade for 15 minutes or less and it's a loser, it's usually a massive loser. So my sweet spot that I found is about an hour to an hour and a half. That's something you can only get by actually looking at a good sample size of your data, of your trading history, and then figuring out what you can improve. Okay, so that's the quantitative side, things you can measure. Now, on the qualitative side is things that you can observe, things that you can't really put into numbers or into a statistic, but you can understand it. So things like how you react under stress. What's your relationship with winning and losing now? This kind of late into the game. What's still holding you back from, holding some trades or, maybe entering when the market gets to your entry, finding the root cause of your hesitation or the root cause of your complacency. And I've dealt with this at every phase. If you try to grow too fast, first you're going to be very confident. It's just a game. You play it, and then you take a few big losses that are bigger than what you are normally used to, and it starts to make you hesitant. You have to detach yourself from these things, but you can only do that by doing this review, by reviewing yourself and being like, what am I really doing here? When I'm losing, I end up doubling down and trying to get back in. Why? And so really getting to the root cause of why you're making decisions on the charts. And I think that if you do this exercise, like 2025 could be transformational for you. Not can be, it will be. It's very few things in life that can guarantee you a successful outcome. Observing previous data and previous history, learning from it, building new rules, and then attaching those rules to like daily actions until they become a habit, that's a pretty guaranteed way to have success. You do something, you're not good at it, you do it almost every day, you improve, you're consciously doing it. You're not just trading every day like you show up and just move the weights at the gym, like up, down, you do the motions and go home. No, no. If you're in there actually focused, if you're in there actually paying attention, you're going to make a lot more progress and make every rep count. That way you're not out there, wasting time and wasting energy. Same with trading. Learn from every single trade. That way you don't have to sit here for years or 6 months or 8 months just to get to the point where you want to be. Put a one in the chat if we're all on the same page. Something in the chats. Are we people? Are we alive? What's the takeaway from what I just said? Like big picture takeaway. One sentence. You can phrase it however you want, but what's the real takeaway here? All right, Chart Addicts members on the Zoom. Everybody's throwing ones. We got Max, Bobby, Roman, Noah, Roman. Good to see you on here, brother. Two step. Yep. Oh, Devaney is on here. What's up, Devaney? What was the key takeaway? Someone let me know. Devaney says, learn from your mistakes and your trading journey. Yep. And specifically, how do you do that? Is at the end of the year, do the annual review. It takes time, but find a good time after work, late night. No one's blowing up your phone. Kids are probably already on their way to bed or damn near in bed. Put on some headphones, grab a drink or grab some whatever your favorite thing is, and then just sit down and do the review. Now, once you've done the review, this like using FX replay has really changed the game for me. You can use the free trial just to get the hang of this thing and just see how it works. But I'll show you guys how this works at the end of the stream. You can then you can do a test run before you do the review and see your results. And then do the review, figure out where you're going wrong, and then come back and do it again. Do a different session and look at your results. Look at the difference. If you stop taking that one trade that you keep trying to force and instead stuck to the model that you see the most consistently, that you know is your winner. Like the thing about trading is if you're taking 2 trades a day or let's say 4 trades a week, you're not getting that many data points. You're getting 12 data points a month. That's really not enough to see all the different variations of the system and to be able to really like get context on it in a short amount of time. With FX Replay, you can take 100 trades in a session in a day of all different time periods from 2019 all the way up to 2024. And so that's how you can see this thing over and over and over. And repetition is going to be key for you to build that second nature. Because the only way to build this kind of like the right decisions into your second nature. So that way, like when you don't know what to do, your first guess or whatever option you choose when you roll the dice is usually going to be the right one because you've practiced enough. And so pattern recognition, repetition, do the review, test yourself, and take this serious, people. All the answers you need are in your results. Century says plan, execute, iterate. You know what? I like that. PEI. Plan. I'm writing that down. Plan, execute, iterate. Iterate just means to make incremental progress, step by step. So not sitting there reinventing the wheel every time that you don't get the result you want, but instead making adjustments so that you improve the overall outcome. Devin says also keep a record of your trading journey. Very important. Now, if you're using a third-party platform like a prop firm, they have all the tracking data there. And so it would be pretty easy for you to go through, even if you have multiple accounts, or especially if you have multiple accounts. TradeZella, I'm pretty sure, has a way for you to connect all your prop firm accounts into one dashboard, so you can see like an aggregated number. FX Replay, for example, for the simulations, you can get an individual account total, or you can look at the total results on the dashboard by including all the different accounts. Now, clearly, this is the simulator, but this is how it would look: is that you would have like your win rate, the total amount of trades, you'd have your buys and sells, kind of show you which side of the market you're making most of your money on. Max risk to reward, total trades, profitability, performance by time. This is a really important one. Performance by day of the week, also really important. Just kind of total performance in terms of percentages, just to get an idea. So having a aggregated dashboard, I think will be very important to, like, you want to see the total, right? Because it's really easy to like not do well on a few accounts and then do really well on one account and just kind of have that recency bias where we're going to focus on the one that went well. But that's not where the progress is made, is it? As a trader, most of the progress is going to be made by, well, I mean, really, it's, I guess, like learning from losers and winners, winning trades and losing trades is equally as important. But I think that you will learn more from the losers because they'll have a bigger emotional impact. Like as adults, I'm gonna just put you guys in on a secret. You know how they say you can't teach an old dog new tricks? As an adult, really the only way for you to bake in a new lesson is through emotion. And in some cases, if you're really stubborn, it might take trauma in order for you to really get a shift in perspective. So when you take a loss and it hurts, you're actually at that point in a state of heightened susceptibility to new information. Okay, so you should use that instead of kind of being down on yourself and kind of beating yourself up or whatever, to then transmute that emotion into focus to figure out what happened and what went wrong and how you can prevent that from happening next time. If you enter too early, jot it down. If you enter too late and you got caught in the retest, and now you're in drawdown, and this happens over and over again, write it down. That's all it takes. And so the losers will teach you a lot about how to avoid losing, which is step number one in trading. Contrary to popular belief, your job as a trader is not to make money. Okay, that comes second. Your first job as a trader is not to lose the money. And most people really don't think about trading that way. That's the difference between someone who considers themselves a risk manager and someone who is probably more on the side of gambling, which is I'm willing to, and it's not really gambling if you're willing to take risk in order to get a return. That's what we're all doing. But if you're willing to lose the money in exchange to make money, that's kind of, you're hustling backwards. Because if your whole job was to get on there with a balance, let's say $10,000, and then to leave with more money than you came in with, right? So, all in all, I want to sum this up before we get on to any more questions here. To sum this up, annual review, probably going to take you guys a few days to do the quantitative and the qualitative. Elicit some help if you need to. We offer coaching at Chart Addicts. You can work with somebody who's an expert in trading or in trading psychology or in helping traders kind of see where they can make improvements. Or if you have a trading friend or someone that you love and be like, hey, look, when I have a losing day, do you notice that I act different? And kind of ask a list of those questions to somebody that you're very close to, and they're going to give you some great feedback. Be like, yeah, no, I have noticed that you're very quiet on those days. And you'll start to realize losing trades are affecting other aspects of your life. And those aspects are kind of weighing on you. And so now it's affecting your trading in response. And so if you don't let trading affect you, win or lose, and that usually comes down to leverage. Like if you're risking too much, you're going to be more upset, right? No one's going to be upset at losing 5 cents on a trade. So it always comes back to over leveraging. But if you notice that it's affecting the rest of your day, you have to make it a priority to no longer be affected emotionally by trading. I mean, most importantly, when you get off the charts. How do you do that? Keep lowering the risk until you're at a point where you just don't care. If you're risking 200 a trade and you can't help but stare at every single candle by candle. Now imagine you're only risking $5 instead of 200. Would you care? The answer is no. Like you'd still want the outcome, but you wouldn't be glued to the chart the same way. And so again, it always comes back to that risk factor, right? Until you're confident. These are big keys, man. These are big keys. All right. Besides that, you guys want to do some charts, or you guys want to just review a podcast or a video, or you guys just want to look at economic news and I can just roast economists? What do you guys want to do? We can go to the Fed website and just look at like kind of a year-end review, see where unemployment's at, where GDP is at, where inflation's at, and kind of what the progress has been over the last administration and specifically in 2024. Or we can pull up a podcast of ours that really hasn't gotten much love. We can go through it kind of like in an interactive way, or just see what's out there in terms of economic news or political news and just, you know, listen in and just do some reactions. Let me know which one you guys want to do. Is it all three options? It's Friday. Yeah, we can do all the above. Can we talk FX Summit 2025? Let's do it. What's on your mind, Sentry? While you load up that question, I'll pull up the Fed website here. College unemployment. Oof. So GDP, inflation, interest rate, college unemployment, unemployment, and then we'll do PCE as well. Okay, let's go one by one here. All right, let's look at the 10 years. So, so right before COVID, this gray bar represents recessions, and specifically, this is the 2020 recession. So we had inflation start to jump, and then we had a massive decline because of the lack of productivity. And so the Fed was really trying to stimulate inflation. We ended up having a remarkable amount of inflation. I think it topped out at 9%. This is the median, but I think if we went to the average, it would show that 9% number. But this is a massive rise. This is what happens when you print trillions and trillions of dollars into the economy. Right. So then 2022, they reversed course, started doing quantitative tightening. They were raising interest rates, raising interest rates, raising interest rates. Inflation was coming down. And then June 2024, this is when, well, September, they decided to do that 50 basis point rate cut. And I think that inflation started to tick a little bit higher just as a result of the rumors and then obviously the decision. So we almost had, it was 2.3, jumped up to 4.1. So now we're seeing inflation come back, we're seeing CPI come back down, but with the Fed's direction going into 2025 with raising interest rates, or sorry, excuse me, with cutting interest rates, I think that we're going to see inflation tick back up. We did a whole stream on this about a week and a half ago. So we talked about the Trump policies, the inflationary effects of tariffs, the inflationary effects of some of the bills or the resolutions they're planning on signing. And also we talked about the effect of the cutting interest rates in the middle of all this. And so I do think that we're going to see this uptick, but if we just kind of look at this trend, it's very consistent with the Fed's decisions. First, we had COVID. no productivity, so inflation was at the ground. Then they printed way too much money. 2021, inflation's already at 6%. Biden decides to drop that omnibus bill for I think $2 trillion. When inflation was already starting to come back down. So we were coming down from 6.5. We were coming down, it was like around 4.8. Once that money hit the economy, those extra PPP loans and the extensions and all of the extra stimulus, that's what ended up surging inflation. Okay, so 2022, they started the quantitative tightening measures, and then 2023, we saw inflation come back down meaningfully. All right, so that's what we got in terms of inflation. It's under control. Probably going to tick back up next year, but hopefully they have it under control going into next year. So let's take a look here. This is college graduates, the unemployment rate for people who graduated from college. All right, so clearly it was at the all-time highs here after COVID, and then we sort of come back to the average. It's a little bit higher than it was historically, but nothing concerning. Like we're still kind of at the bottom end of this range. So it seems like folks who have a college degree aren't doing the worst. And we talked about this on the stream too on Sunday, I believe, or maybe it was last week. In terms of the job market, right now is a good time to keep your job, not a good time to go find a job. So a lot of the folks that have a bachelor's degree that are college graduates, looking at the employment rate in general, everybody who already has a job is incorporated in this and they're not at risk of losing it. Anybody who's still looking for a job, that's who's incorporated in this. And it looks like things are pretty stable here. So that's good sign. M2 is the total money supply. So the total money supply in the system is measured in three different ways. It's M1, M2, and M3. M2 is basically all the money that's in people's bank accounts, that's in transfers. You put in a check, it hasn't landed in your account, that's incorporated. You sent a wire, it's going to take a few days, that's in there. And so really it's just all cash and liquid equivalents in accounts. This is like a good proxy for the total amount of money that's just floating around the system. So you guys can see before COVID, the total money supply for M2 was $15 trillion. Post-COVID, just from 2020 to peak in 2022, that was about $7 trillion. So it went from 15 trillion up to 22. Okay, just for context, the M2 money supply was sitting at 1 trillion. Okay, in the year 2000, it finally broke 5 trillion. So this thing took like 30 years just to go from 1 trillion to 5 trillion. 30 years. And then from the year 2000 to 2020, or sorry, from the year 2000 to the '08 financial crisis, 8 years, we only printed $2 trillion after the dot-com bubble. And then from the great financial crisis, 2008, all the way to COVID, okay, it went from 7 trillion all the way up to 15, almost or more than doubling the total M2 money supply. That was the result of QE1, 2, and 3, and the Obama program TARP, which was basically like a bank bailout program. A lot of money in the system. That money found itself reflected in new loans being issued, new debt, new credit, and that money just kept recirculating. Okay, then in COVID, you see this like uphill 90-degree angle. This is how extraordinary the last 4 years have been. That's why everything just seems so off. Economists don't know what's going on. Projections are all over the place. What's really happening here is the 15 trillion to 7 trillion, or that 15 to 21, that only took 2 years. So not 30 like before, 30 years or 8 years. This thing in 2 years, we completely ballooned the money supply. And that's why inflation's been sticking around. Okay, and you can see that they tried to take some money out of the system. It didn't do a thing. We're still sitting at around $20 trillion, 21 trillion, excuse me, basically where we were at the peak. So they haven't taken a dime out, right? Net. This is not a good sign. Even in the 1 year, you guys can see these are probably the result of bailing out a lot of the regional banks. I do 20 trillion up to 21, 21 and a half. This has been an uphill climb. So if they say that they've been reducing inflation in 2024, this current administration, if they try to make that lie, you guys can see it right here. This is a very, very clear uptrend. So M2 money supply growing, that leads to Bitcoin or all cryptos, stocks, basically risk assets or high beta assets, assets that overperform general market returns. They are beneficiaries of money being printed. So people ask me, Roy, what data points do you watch for Nasdaq and for crypto? To stay ahead of all these market cycles. Really, it's is the money supply going up or is it not? Because if there's money in the system, people are going to take risk with that money, and it ends up in risky assets like stocks, specifically tech stocks and cryptos. Put a one in the chat if we're all still on the same page. We good? Century, I'm gonna get to the questions about Colombia here in just a sec. Let's finish up with GDP, and then we should be done here. All right, so GDP has been on a steady rise, but this is also credited to the rise in prices. Okay, so if everything's more expensive, the total production is going to go up in like dollar terms. But is it really getting more productive? Okay, a lot of people would argue, myself included, that a lot of this productivity growth has to do with number one, during COVID, it was about as bad as it can get. But the thing about inflation, which is only going to get worse over time, it's going to be like a downward, you'll see like a downward chart for the value of the dollar. Okay. And then GDP is going to go up and asset prices will go up because if you're going to print more dollars, the whole, like the way that you measure everything, you're just going to put a zero at the end of everything. And so it's not like we became, from 19 trillion up to 29 trillion. We didn't become $10 trillion more productive or almost, 30% more productive over the last 4 years as a country. Quite the opposite, honestly. But I think because of the rise in prices, this is giving us kind of a false indication of the rise in GDP. Now, this is what a lot of global leaders look at. If you're going to judge a report card when you go to like a G7 meeting, you're going to look around at France and England and everybody else. You're basically judging them on their unemployment rate, their GDP, their inflation rate, their overall just production as a country. And so if these numbers are going up, it's really hard to argue that America is not leading the charge. But this number is flawed. I think we'll actually see this number balloon, in the Trump presidency. Number one, because of actual productivity growth, job creation. And number two, again, because of all the inflationary um, plans that he and his administration have, including the Fed's decision to cut interest rates. So you have inflation that's still going to tick up. So shit's still going to be expensive, but we're also going to be producing a lot more. People will get paid more. And so I think we're going to see GDP continue to rise in a Trump presidency. Okay, federal funds effective rate. This is the interest rate of the Fed. You guys can see they were raising interest rates from 2022 all the way to 23. In 23, they kept it still at 5 to 5.25%. And then they've slowly been reducing the Fed funds rate. So if we look at the expectations of next year, so if we do Fed Watch from the CME, and we go look at what the money markets are predicting, the next Fed meeting is in 33 days, but this is going to be a proxy for what the money markets are predicting in terms of interest rate decisions next year. So in the January meeting, late January, the money markets are expecting a 90% chance that interest rates will remain the same. So no cuts to start the year off. And I think that's a very smart move. You don't want to like just blast the market starting, to start the year. There's about a 50-50 chance of getting a rate cut in the March meeting. Everything else is about 40-40, 40-25, etc. Okay, so there is a chance of about 2 rate cuts in 2025, but I think they'll when Jerome Powell was speaking the other week, he mentioned that they're going to bring the effective rate down to about 3.5%. So from 4.5 down to 3.5, that's either 2 cuts at 50 basis points, which I think is way too aggressive, or they're going to do a bunch of 25 basis point cuts and spread them out through the year, just to like not spook the markets. Okay, so that's what we can see in terms of interest rates. They're going to come down to about 3.5 next year. That should boost the markets for the short term. I mean, going into like Q1, kind of a bullish market sentiment because everyone's expecting that those cuts to hit, whether it's in January or February, the markets are forward looking, usually about 6 months. So they're not really like playing catch up here the same way most of us are. So M2 will be increasing, causing more inflation. Exactly. 100%. So what's the idea behind hosting in Colombia? So the goal is to really hit as many locations as we can to bring the opportunity of the FX Summit to everybody. Dubai kind of was an eye opener just to realize how inconvenient it is for a lot of folks, especially Western Hemisphere, to make it out there. So the goal really is to do one in Latin America, to do one in Asia, one in Africa or Middle East Africa, MEA, and then one in Europe and one in the States. I might skip Europe, but we'll see. So the goal around Colombia was we went down there for a workshop, I think about 6 months ago, and we did both cities, both major cities, Bogota and Medellin. And I think we had about 1,000 people in each city. And this was on 3 weeks' notice. We saw the hunger, we saw the dedication, we saw how committed people were to coming out there and learning. We saw the community out there and community building, people holding each other accountable and going out there and playing with this information and like really following back on all of the networking that we all did. So there was an energy there that we felt was absolutely critical to engage with the FX Summit. People who are genuinely hungry for information, people who genuinely want to learn and better their trading or just even get into trading if these folks are new. So really the idea behind it is very, very great crowd. People are ready for the FX Summit there and we're ready to deliver. It's about as straightforward as I can get. Africa is fire, 100%. We're going to be thinking about either South Africa, Nigeria, or Ghana. We'll see. I think Nigeria and South Africa are our two biggest audiences, so we'll have to consider those for sure. And then Singapore is coming very soon. All right. Any questions, comments, concerns? We good? You guys want to throw out some news that you heard? Any financial news or political news? And we'll just kind of we'll look it up and just talk it through. I'll do like some live reactions here. Something you might have saw on Twitter, something you guys saw just on, maybe you got a news alert on the news app that you use. Oh God. You think we'll see a housing market crash next year or anytime soon? Actually, it's the opposite, bro, because interest rates and housing prices move opposite. If it's cheaper for me to go get a loan and it's easy for me to get cash, and everybody's gonna go do it. And if everybody's gonna go get a loan to go get a house, then that price of that house is gonna go up just because of the supply and demand. And so typically with low interest rates, housing prices go up. Because here's the deal. If let's say like at the current price and interest rate, it's going to cost you 5 grand a month to finance that house. If the interest rates come down, now it's only going to cost you about 4,200. If the price of the house goes up, you still get about 5 grand for the mortgage. And so what they do is like they try, the market kind of plays this game where whenever it becomes cheaper for you to go borrow and get money, they'll just, you know, there's a lot of buying pressure. Right now, there's an artificial buying pressure from big firms like BlackRock and Vanguard and State Street that are buying commercial properties. So people who foreclose on their properties or are bank distressed, they're buying those. They're buying residential properties right now with an adjustable rate, knowing that they can hold it for 5% and then refinance. Most of us, most consumers can't just hold a shitty interest rate and then just wait 2 years and then refinance it to get a better rate. It's not worth it. It's better to just wait for the lower rate. But when rates are really high like they've been, property values start to come down to try to incentivize people to get in the game, to go buy houses. And so I think that's what we're seeing now is like housing prices they weren't low, but they were lower than they're going to be. And then now when interest rates are coming down and there's going to be more demand for housing, I think that the prices are going to start to skyrocket. And that's going to be accelerated by that buying by BlackRock. So not only is there going to be a housing crash, it's going to be the opposite. I think we might see a housing boom. Um, Maybe we can do a whole stream looking at development, looking at like the building rates, looking at construction, looking at open permits, and then looking at like homes under construction. Those are really good metrics to see, not homes that are on the market like that have a bid on them, but homes that are under construction. Because people who work in construction, it's really expensive to build something and then have it not make you money, right? So if they're out there and if everybody's building and there's like a consensus that they're all expecting more demand, then that's a pretty good tell that there is a lot of housing demand out there. If we start to see the building rates go down, the amount of homes being built, the amount of permits being issued, and the amount of homes under contract on the market, that's a pretty good indicator that the market's slowing down. No one's on Zillow and all these, no one's calling their real estate agents, and all of these are just early indicators. Thanks, Roy, for Africa. Please consider Cape Town. The trading culture general here is insane. A lot of people would do way better if they had something like FX Summit. Cape Town and South Africa. I appreciate that, Century. Definitely noting that for sure. Intrigued how the new tariffs and immigration policies will impact GDP this upcoming year. Good point. So I think that there's a balance here. Okay, you guys got to understand something about accounting. Accounting is a lot of smoke and mirrors. It's a lot of fraud, basically. Because as I always say, when data releases drop, it's not about the number, the nominal number. It's about the expectation of the market and the analysts versus whatever number came out. And so it's the same thing with countries where you can make so like for example, when Biden dug into the strategic petroleum reserves and then basically dumped all those barrels on the market so that the price of gas can come down. You can artificially manipulate inflation, CPI, to make it look like it's coming down, just off of impacting one of the most important components, which is energy. Energy and housing are the biggest components. Okay. So the GDP numbers right now, I believe, are being cooked by inflation. And so because of those inflationary effects of tariffs, I do think that GDP goes up. Now, Trump is one of the first presidents that's actually tackling the reality, which is the spending, how much money we're actually putting out there in the budget, and then the revenues. So these tariffs are supposed to bring in revenues. And really, guys, listen, most of the tariffs are just scare tactics. All right, because everyone's going to fold. And Trump likes to use this example, but I think it's a perfect example when France was so basically America pays the majority of the defense budget for the Europeans, the Eurozone. So even though that there's NATO and everyone's supposed to pay, I think 3% of their total GDP, America's the only one that does that. And the rest of the countries don't. And they basically just ride off the back of the US. Fine. We have the most advanced military and the largest military force. We spend the most. Got it. But now when we go to import Ford and GM and American made products to France, we get taxed like madness. So people out there can't buy a Chevy or a Ford. Like a Camaro is a luxury car in Europe. It's the same as, seeing a Porsche or seeing something, very exotic here. Maybe Porsche is not the most exotic, but you guys get what I mean. And so what Trump did is he called Macron and he said, basically, we're going to issue 100% tax on all products coming in from France. All the wine and the cheeses, basically those are the main exports. It's wine and cheese. And Macron was like, no, you guys can't do that. That's, like it would crush our economy. And Trump said, too late, already signed it. Sucks to suck, hung up the phone. Macron calls back and he's like, look, all right, we backed off. We're going to remove the tariffs on the American products. And, please don't put the 100% tax. And it worked. And so I think this version of like, there's two ways to handle these things. There's spiteful proxy war, where basically you're fighting for territory. We're using Ukraine to basically spite Russia, etc. Or there's economic war, which I think Trump is a master at, and I think is much better for society because it's devastating, yes, but you can't be suffocated for like forever without caving. Someone's going to cave. And so these tariffs are really more of like not a scare tactic, but really like a strength tactic to get folks to make an action, which they will, and then the tariffs will be lifted. All right. Um, yeah. I mean, look, the best example of the economic war is when Trump told told Turkey not to attack, I believe it was either the Kurds or the Armenians or somebody as they were retreating. And he said, if you do that, there's going to be hell to pay. And then as soon as Erdogan basically was like, well, I can't stop them. They're going to do what they're going to do. And they attacked our allies as they were retreating, in their own territory. Trump crashed the Turkish lira in a matter of one tweet. The entire economy of Turkey decimated with one sanction. And then they apologized, they did a whole thing. They held people accountable. So these things work, and there's no lives lost, and there's no cybersecurity warfare. There's no drone warfare, or maybe some drone warfare. But this is all just about incentives, and this is all about sticks and carrots. So yeah, that's my take on the tariffs. Thanks for that explanation. Makes total sense. Canceling student loan repayment programs. Why and what is that supposed to do for the economy? So I'm kind of in the middle on this. From a fairness point of view, number one, that there's a lot of student loan or there's a lot of the national debt that's held in student loans. So if you say national debt clock USA, we take a look at this together. Let's look at the total percentage of the debt, the student loan debt. Okay, so the total US national debt is 36 trillion and our GDP is 21 trillion. So we have a lot of debt. Okay, but let's see what the biggest components are. It's Medicare and Medicaid, so entitlement benefits, Social Security, which is kind of tied to those entitlements, war and defense, and then interest on new debt. So the interest on the debt is $1 trillion. That's insanity. Just to keep the debt going, just to be able to finance and service the debt. Where's student loans? Student loan debt, $1.7 trillion, more than we spend on defense and war. All right, credit card debt is 1.3 trillion. Student loans is 1.7 trillion. So canceling 1.7 trillion when we have a deficit that's this big, the budget deficit is 2 trillion. In 2024, we spent $2 trillion more than we brought in tax revenue. Then we brought in about $5 trillion in tax revenue this year. There it is, $5 trillion. And then we spent 7 trillion. So where did that extra $2 trillion come from? We printed it. We issued debt and then we bought our own debt, but we have to pay it back. And so how we pay it back? Well, with interest. Isn't that crazy? So canceling student loans would definitely hurt this side of the balance sheet because we would, that money still has to get paid back. Now, on the other side, the predatory nature of the government-led student loan programs, I think was definitely taking advantage of young people and folks who just didn't know better. And I don't know, it's just very predatory. So, for example, you have an 18-year-old kid, and like if you guys are business owners and you try to go get a business line of credit, unless your credit is top notch, you've probably dealt with some issues regarding getting a big credit line for your business. Now, if you're 18 years old, you can go get $80,000 or $60,000 in debt for a degree that you don't even know you're going to use. You don't even know what the fuck you're studying. You're just figuring it out. So then by the time that you're 22, you've racked up about 100,000 in debt. This is just a very extreme example, but 100K in debt. Okay. And especially with today's job market, you will not be able to get a job that pays well enough to be able to finance this. Now, the good news is this 100K number stays 100K. Inflation is going to make your wages go up. So whereas your average salary for that job you were going for was 80K a year, now it actually might be 110. Maybe not right now, but maybe in the next 2, 3 years, it'll be on average in your industry about 110,000. But you'll still owe only 100K. And so there is a way that inflation can help you pay off the loans and pay off that debt. Now, interest is usually the killer here because the interest grows so much that you're basically in a revolving door of, debt forever. Student loans are the only debt that you can't write off with bankruptcy. Like, tell me how that works. So if you can't pay it off and you're fucked, you're fucked. They want you for life. So there was a pernicious aspect to it. The costs of education were ballooned for no reason because we see how much profit the colleges are making, and we know that they could easily lower the cost of tuition and cut their profits, still make billions, but cut their profits since they don't pay taxes, and then let students get a better and cheaper education. But no, since the government was going to pay for it, they just ballooned the price. That's what people do to take advantage of the government. The government pays the most for everything. So if there's a defense contract and they know that the government's going to pay for it, they'll increase the cost. They'll do cost plus. I mean, whatever the listed price is, plus whatever extra costs come in. And so whenever the government gets involved in something and then subsidizes it, it usually leads to it being shittier and more expensive. Healthcare included, education included, policing included. Got it? So I don't know if that answers your question, but that's a pretty good rundown there. More money than defense and war is crazy. Yeah. We owe a lot of money to people who are retiring, and the baby boomer generation is going to retire at basically a record pace here. There's going to be a massive wealth transfer. I think we've all seen this. Obviously, there's going to be estate taxes, death taxes, a lot of taxes getting paid, but there's also going to be a lot of properties getting passed from hand to hand. There's a lot of assets getting sold, maybe for cheap. A lot of folks who, um, I mean, most wealthy folks have a pretty good wealth manager, but some folks who don't, they didn't really have a good plan of paying their estate tax and their death tax. And if you're a multi-millionaire, you have assets and stuff, they want a big chunk. They're going to want a $12 million check or whatever it is. And so a lot of folks end up selling properties and selling assets and selling paintings and selling memorabilia and stuff just to finance some of those costs. And so a lot of stuff is going to be on the market. There's going to be a lot of money moving around in the next 4 to 5 years. And if you're not paying attention, you're not going to capitalize. If you are paying attention, follow the money, right? Figure out where the future is going and get there early. That way, when the hype gets there, you're in at a good price. Not financial advice. Please consult a licensed financial professional. That's what I got for you. All right. Any questions? I'll take one more question. I'm a realtor, brother. Let's break those numbers down. What are you talking about, Gabe? Oh, you're talking about the housing price numbers? Or are you talking about the relationship between interest rates and inflation? All right. Side note for Nasdaq, I think that first entry is going to be, I'm telling you guys, just a scalp. It's going to wick up, and then if it ends up just gapping back in, like same candle, probably going to look at this on, got 6 minutes left on the 1 hour, 2 hours left on the 4 hour. So I think like the 4 hour is probably going to be a pretty good time frame to watch here. Kind of stick into the big picture. When in doubt, zoom out. And so if we do get this candle here with that rejection that we were originally looking for at the beginning of the stream, if it wicks up and then just fills and looks exactly as it looks right now, like near that last hour of the candle, typically we're going to have that move to the downside, or we'll have like a dip inside, retest, and then come back in. So overall, I don't see this being like a full continuation move. I could be wrong, but I do see this thing being a scalp and then coming down for the real trade, which is going to be down here at the 88.6 correction. Bitcoin had a beautiful, beautiful retracement. We were looking at this when it was at 108,000. Kind of had this expectation that price would come back down to about 87,000 and then continue to the upside. I still believe that we could have one more big push to the downside before we continue this bull run. If we look at coins like XRP, for example, as well, same thing. Go ahead and reverse this fib. XRP actually, it's sitting at a pretty good range here. I think that if we just stay above $2, then it's going to be our temporary floor here. Got a beautiful wedge forming that could indicate a continuation, right? So we could either go down and then up, or up and then down. I think that we're going to see this fake up, fake down, and go. Same with all consolidations, whether it's a wedge, channel, or just a range. Like this is for the members specifically. Whichever the direction of the first fake out is, that's usually your real direction. The market will fake in that true directional trend, come in for that liquidity grab, and then finish in the real direction that everybody anticipated at first, but they were all chasing it and were early. Okay, so I think that we see a little bit of a dip down, maybe past $2, and then if we break back above $2, that's going to be our threshold. Under $2, not too good of a sign. Above $2, we're back on track to make that continuation. DXY hit that last magnet zone. I would not be surprised if we saw a correction from here. Once that last magnet zone gets hit, you guys can see super secret magnet indicator does not lie. When the market hits one of these zones, we see a nice release. Okay, we see a nice release here. Over here, no rejection, but we did end up using it as support. And then we did have a beautiful rejection off that top rope, 107.5. Typically, this sort of like extended double top, we might see one more drive up, like a three drive pattern, and then a move back in. So I think one more drive up, and then we see this correction on the dollar. The dollar is very overextended. Okay, this is the kind of comfortable range that we really want the dollar playing in. Anywhere between 100 to 108. That's kind of that rate. If we start to break above and we really start to fill, I think it's going to create a lot of a lot of pressures that will make the tariff situation even worse. Because currency relativity to each other is really the kind of like the underlying determining factor of trade balances. Right? So the relative strength between the dollar and all these other currencies is going to determine who's importing more and who's exporting more. A weak currency can import more stuff, but is going to get paid less for exports. And a country that has a really strong currency can buy a lot of stuff, but nobody wants to sell you stuff because you're going to get paid less in local dollars than you will in American dollars. So the import-export balance, and I might have butchered the first part, but you guys can look this up. You know you get what I'm saying. But yeah, that balance is really determined by currency correlations. Euro USD following the dollar. And then let's take a look at Nasdaq. Nasdaq already filling back in. So that's it. You guys got the levels. I'll keep you guys posted in the chats. I'm not taking any trades unless it hits this bottom 88.6. So you guys get exactly what I'm looking for. Catch you guys there. Next Nasdaq Masterclass will be hosted by our very own Jacob and then maybe a few guest educators. So the Nasdaq 1.0 Masterclasses will come back. I will not be teaching those. I'll step in, of course, say a few words, answer questions if needed, but we're going to be offering the coaching with the classes. And then the Nasdaq 2.0, the recordings, those will also be available, but that's going to come a little bit later. So keep an eye on the email. We're getting our Instagram back, right? I'm working with some people who work at Meta. I'm doing my best, people. All right, we'll see if we can make this work, get the Instagram back. But until then, go and subscribe to the email. It's on our website. Easiest place to go find it. Okay. Catch y'all later. Happy and safe trading. Take it easy.